What if the most repeated chart in crypto, the one we've all seen 1,000 times, isn't just bent? What if it's broken? I'm talking about the Bitcoin 4-year cycle. For a decade, it was a predictable roadmap. The bear market, the pre-halving rally, and the euphoric surge to a new all-time high. It's the story that told us 2026 should be the next chapter. But what if that story is now a fantasy? What if following that old map leads you into a trap set by an entirely new player? The old 4-year cycle is dead. The game has been fundamentally rewired by institutional giants who are not playing by the rules we all learned. The launch of spot Bitcoin ETFs was a structural shift so massive it changed everything. Trading based on old patterns might be the most dangerous mistake an investor can make. In this video, we're tearing apart the conventional wisdom. We'll break down data that reveals how the market structure has been rewritten and lay out the strategy you need to navigate this new world. This isn't about hopium. It's a deep dive into the new rules of the game. To understand why 2026 is so different, we have to respect the past. For years, the 4-year cycle was a reality driven by a simple piece of code, the Bitcoin halving. Every 4 years, the reward paid to miners for securing the network gets cut in half. It's a programmatic supply shock that created a clockwork pattern. First was the accumulation phase, a soul-crushing bear market where smart money built their positions. Then came the growth phase, a rally into the halving as anticipation of the supply cut built. The main event was the bubble phase, typically 12 to 18 months after the halving, when a wave of retail FOMO pushed prices to incredible new highs. Finally, that euphoria led to the inevitable 80% crash that reset the board. 2013, 2017, 2021. The pattern was clear because the market was driven primarily by retail sentiment and leverage. The core assumption was that the halving was the single most powerful scarcity event in the market. That assumption is now obsolete. So, what changed? The game changed forever in early 2024 with the approval of spot Bitcoin ETFs in the US. This wasn't just another news event, it was a structural rewiring of the market. For the first time, the largest pools of capital on Earth, pension funds, sovereign wealth funds, and retirement accounts, had a regulated, insured, and simple way to buy and hold Bitcoin. And the floodgates didn't just open, they created a new ocean. Let's look at the numbers where the old theory completely falls apart. The April 2024 halving cut the new daily Bitcoin supply from 900 to 450 BTC. In the old world, that was a massive supply shock. But in the new world, it's a drop in the bucket. In February 2024, the ETFs were absorbing over $200 million per day on average, eating up nearly 8 times the entire daily supply from miners before the halving even happened. But after that initial explosion, the market changed. The excitement cooled, and 2025 turned into a grinding year that left many confused, with major ETFs like IBIT even posting a negative return for the year. The tsunami of demand became a choppy, unpredictable current. This is the critical point. The cycle is no longer about a predictable supply shock from the halving. It is now about a much larger, far less predictable demand shock from the ETFs. The scarcity isn't just from fewer new coins. It's from the erratic absorption of existing coins from the open market. This hasn't created a straight lineup. It has created a completely new market structure. If the 4-year calendar no longer runs the show, what does? The answer may be what's being called the cost basis cycle. This isn't a cycle driven by retail hype or halving dates. It's driven by the mechanical behavior of the new kings of this market, large-scale institutional buyers. Research suggests that since the ETFs launched, Bitcoin has entered a pattern where the market repeatedly gravitates back towards the average price where these big players bought in, their on-chain cost basis. Here's how the theory works. Institutions establish a huge position, creating a new cost basis floor. From that floor, the market expands, perhaps 60 to 80%. But instead of a retail-driven blow-off top, The price resets back toward that institutional cost basis as firms rebalance or as new waves of capital establish an even higher floor. This is the new game. It's no longer about a predictable sentiment wave. It's about structured, mechanical expansions followed by resets to an institutional floor. The on-chain data shows this. Exchange reserves are at their lowest levels in years as coins are drained into the cold storage of ETF custodians like BlackRock and Fidelity. That capital is sticky. Institutions don't panic sell like retail traders, but they also don't FOMO in. Their buying is calculated and creates a different kind of market. Believing the old cycle is intact is like trying to navigate a new city with a map from 30 years ago. You will get wrecked. Here is the critical shift you have to consider for your strategy. First, be prepared for a different kind of volatility. The days of a single 80% crash signaling the bottom might be over. Corrections are more likely to be the grinding 30 to 40% drawdowns we saw in 2025, the kind that wears you out. If your strategy is just waiting for an 80% discount, you might be waiting forever. Second, your new North Star is ETF flows. Forget counting the days since the halving. You need to watch daily and weekly ETF inflows like a hawk. A sustained slowdown is your new warning signal, and a reversal to major outflows could signal a serious downturn. This is the data that matters now. Third, understand the new battleground numbers. The cost basis cycle gives us a new map. Taking the November 2025 low of around $84,000 as a potential institutional anchor, a 60 to 80% expansion from there would put the next zone of interest between $135,000 and $152,000. These aren't guarantees. They are thought experiments based on this new model. On the downside, the levels to watch aren't arbitrary lines but potential cost basis zones. Places like $84,000, $70,000, or even $58,000. Finally, manage risk like an institution. This is not risk-free. Institutional demand is real, but it's also conditional. That capital could pull back if macro conditions change. While index provider MSCI has recently shelved plans to exclude crypto-exposed firms, ongoing risks like potential regulatory shifts could trigger billions in forced selling. This means your Bitcoin allocation shouldn't be a speculative moonshot. For most people, a 5 to 20% allocation of your total investment portfolio is a much smarter play. The Bitcoin market of 2026 is not the market of 2021 or 2017. The 4-year cycle has been overwritten by a larger, more powerful, and far less predictable force. Institutional capital flowing through ETFs. The old cycle was driven by retail FOMO and the halving. The new cycle is driven by institutional cost basis and ETF flows. The old cycle gave us explosive blow-off tops. The new cycle appears to be giving us a more complex market with a higher floor but a less predictable ceiling. The biggest mistake you can make right now is waiting for a 2021-style euphoric peak that might never come in the same way. You'd be ignoring the fundamental rewiring of the market. If this breakdown is opening your mind to a new set of possibilities, smash that subscribe button. I want you in this community as we navigate this new world together. And I have one final question for you. What's the biggest surprise you've seen in the market since the ETFs launched? Let me know in the comments below. Thanks for watching. The rules have changed. Make sure your strategy does too.